Glad to be with you guys. The AGC of America, you may know, has 88 chapters, of which the East Tennessee is a very valuable membership chapter. We have nearly 28,000 member companies, including 6,500 general contractors, specialty contractors of all types, and suppliers of equipment, goods, and services spread throughout the country. So this has enabled us to do weekly surveys ever since mid-March to track what the impact of the coronavirus pandemic has been on the industry and its workers. This summary of the latest survey, which we completed less than a week ago, shows an alarming trend. 50% of respondents, and each of these are percentages of respondents, 50% of respondents report that an owner had ordered them to halt work on a current project. And 28% now say that projects have been canceled going as far out as June or even later. There are quite a few reasons that they have been doing this, but at any rate, the number of layoffs has been increasing. I think the number one problem in terms of getting projects done is a shortage of personal protective equipment. So it's great to hear that the chapter has found a supply of hand sanitizer. Masks have also been a problem on many work sites. But in addition, a growing percentage of firms say that suppliers are telling them that deliveries are going to be late or canceled. This percentage has risen steadily since we did our first survey in mid-March, and even then 22% said that supplies were going to be late or not delivered at all. Now that's up to 49% of respondents reporting that problem. A bit of good news, contractors have been very quick to report that they were able to get these PPP loans that I'm sure you've heard about. That's the Paycheck Protection Program that's designed to help businesses with 500 or fewer employees keep employees on the payroll or even add back employees. And indeed, this time, 13% of firms said that they had been able to add workers either in March, or nearly all of them had done so. The 13% had done so in April, including a fraction who had terminated employees or furloughed employees in March and had now brought them back. Nevertheless, this is only a short-term solution, and we still have 35% of firms that already say that they have had to furlough or terminate employees. About 18% of firms said that they have won additional work. For the most part, that's some medical type of project, perhaps a hospital remodel, a temporary screening or testing facility, or an addition or a new laboratory. Highway contractors, in some cases, have been able to work longer hours or close more lanes in order to take advantage of the reduction in traffic. But I think all of those things are going to be short-term, and more we're going to be hearing about projects that have been canceled going forward and contractors forced to lay off workers. For construction is, unfortunately, it's likely to be much slower coming back than other sectors. For the rest of 2020, as shown on the next slide, let me take a minute to talk about specifically what data we have for Tennessee and for the Chattanooga area. The slide here shows that Tennessee construction had been recovering slowly but pretty steadily ever since hitting a low point in 2011. And that good news has suddenly hit an end. This data comes from the payroll period that included March 12th. So it was really before coronavirus impacts were showing up in much of the country. But just in the previous year, construction employment gains had slowed to less than 1%, a 0.7% increase, and down 3% from the peak in January of 2008. We also get data each month for 358 metro areas, and the next slide shows what's been happening in the Chattanooga metro area. It was much better news. It was at an all-time high for March. We don't have seasonally adjusted data, so here we can only compare March to March. But nevertheless, you can see that the metro area had finally fully recovered from the slump that happened between 2008 and really the recovery only began in 2014. But it was at a new high in March of this year. However, going forward, and here I'm returning to the national outlook with the next 3 slides. For 2020, I think construction is going to face ever increasing cancellations, very limited number of new starts. Those are going to be mostly related to coping with the crisis itself or taking advantage of the reduction in traffic in highways, airports, the ability to dig up some streets to do water and sewer work and so forth. And then a few cases of industries that suddenly have an increase in demand, that last mile or last hour distribution, for instance, or the a huge increase in usage of facilities such as this GoToWebinar, Zoom, Microsoft Teams, downloading of entertainment and educational videos and so forth, may lead to more construction of cell towers, perhaps build out of 5G equipment and of data centers. But for the longer term, the next slide shows what I expect will be happening over the course of 2020. I think that whereas some state DOTs will be accelerating work, many others will say, wow, we're seeing a tremendous drop in gas tax revenues, so they're going to be putting off some of their bid lettings. Other state agencies also facing unbudgeted expenses, reductions in revenues, quite severe, that are going to force them to put off anything that isn't immediately related to coping with the pandemic, providing relief to people out of work, and so forth. And construction is usually something that is easier to defer than cutting payments or benefits. So the public sector, by and large, is not going to be doing well. Private owners, they are also finding a big loss in revenue or in their assets with the decline in the stock market. And many of them are going to say, well, I don't know how soon I'm going to need this project, if I'm going to need it at all, or even owners that may be out of business. Institutions such as colleges and universities, they're also struggling to figure out what's going to happen in terms of new students or re-enrollments in the fall. Will I need all of that dorm and classroom space? Will I be getting enough revenue from tuition, room, board, athletic events that I can even do new construction? And then looking at their endowments, if they're lucky enough to have one, their capital campaigns. Again, the decline in stock markets has hit those prospects very hard. So going segment by segment, I think the longer term outlook for construction is that it will be very much delayed, and in some cases, we're just not going to see that demand come back. One area that I think is important in Chattanooga and throughout the region, tourism. We'll just have to see how confident people are in doing either leisure travel or having business travel resume. I was just on another webinar before this for the steel industry, planning a conference that they had been expecting 1,200 people to come to Atlanta at the end of August. Now they're not sure if they will do this virtually or in person. And I think that uncertainty is going to be hanging over anything related to tourism, to business travel, conventions, meetings, and so forth. So I think it's going to be a tough time for now, and the path forward will be at a lower growth rate and very bumpy in terms of which segments come back when. So let me stop there and see if there are some questions. I should mention that AGC of America has a lot of resources that we encourage contractors to look at. Our website in general, but in particular, we have an agc.org/coronavirus website, has a lot of tips on safety practices and also information on what new federal programs and what guidance has come along on things like the PPP, on unemployment comp, and on the vast number of new laws, new Federal Reserve programs and guidance, and other tips on how you can cope and hopefully get through this process. And for my own part, I'm glad to take questions by email at ken.simonson@agc.org and to add people to the email list for the Data Digest, my weekly one-page summary of economic news relevant to construction. So at this point, I'd be glad to answer any questions here.
Ken, we did get a question through chat, which says, with the unprecedented amount of QE and current bond rate, do we see inflation becoming an issue in relation to new project starts?
No, I think it's actually just the opposite, that the incredibly low rates that we're seeing. This morning, I saw that the 10-year Treasury note, which is a really very important indicator for home mortgages and other kinds of longer-term borrowing, that was down in the range of 0.6 or 0.7%. Just a few weeks ago, it seemed that if it was below 3%, that was really good news. And so clearly, the amount of borrowing is unprecedented, but the rest of the world still sees the U.S. as the safest place to be investing their money. And I think that's going to continue to be the case, that in spite of this huge explosion in federal deficits, I have to applaud the Federal Reserve and Congress for stepping up very quickly with creative, if not solutions, at least antidotes to some of the problems being caused by the pandemic and the shutdowns. And as a result, I think we won't have an issue about a spike in interest rates for quite some time. Obviously, the debt does have to be paid off at some point, and this will eventually become a problem. But for now, it's an opportunity for private borrowers, if they can find someone willing to lend to them, and certainly for state and local governments that are going into the bond market or that already have a considerable amount of debt. They should be able to hopefully refinance if they need to, but at any rate, much lower interest payments than they may have been anticipating. And so when you're talking about a bond issue for school construction or other kinds of construction projects, more of that money should be available to fund actual construction and not just repayment of the debt.
We did get another question, and I don't know if you're familiar with the tornadoes that hit Chattanooga a couple weeks ago, and actually Nashville about a month before that. So, you know, one of the questions is, how might the tornado recovery affect demand? Do you have any kind of data on how these crises can change what's happening in our market?
Yeah, I can't think of a situation where we've had simultaneously, well, clearly there hasn't been anything as drastic as the shutdowns with the coronavirus, but the combination of a natural weather-related disaster and some other sort of impediment, but that does complicate matters. In general, what we see after tornadoes, hurricanes, fires, floods is that there is a surge of demand initially for stabilization, repair, covering up things that are exposed, and debris removal. And then some demolition work, but for the most part, the reconstruction, new construction, takes a long time. It depends on how quickly the FEMA money comes through, the SBA low interest loans, and private insurance. But I think generally reconstruction takes longer than a lot of people expect initially. And I think that's only being complicated by the need for social distancing and other practices that may slow each of those steps, getting permits, getting the financing, whether it's from a bank or a government agency, getting the crews in place to do the necessary work. So unfortunately, I think it will be a long recovery process for businesses or residences or public structures that were damaged.
Another question, do you see currency exchange rates playing a role in material availability that rely on imports?
Well, we have seen a big drop in crude oil prices, enormous. I bought gas yesterday for $1.95. That probably seems high to you in Chattanooga, but for me, it was a huge savings. And nationally, the Energy Information Administration does surveys every week of truck stops and gas stations. They reported this week that gasoline prices were down something like $1.12 from a year earlier, and the diesel fuel down 77 cents. So huge savings compared to just a year ago. Similarly, steel, copper, other globally traded things have come down in price, mostly because of reduction in demand globally, but also the U.S. businesses have benefited from a strengthening of the dollar. Again, people turning to the U.S. as that safe haven and ultimately having some of the better prospects for economic recovery. Now, those prices are only good if you need to buy the stuff. If you're not buying, then it's not an opportunity for you. But I do think that we are now on a lower growth path for materials costs than I had been expecting. Last year we got a break because President Trump took off the tariffs on steel and aluminum, and diesel fuel, other petroleum product prices came down. The huge drop off in single family home building from the beginning of 2018 to the middle of 2019 meant that there was a less demand for lumber, oriented strand board, plywood, gypsum. Those prices, I think, had all hit bottom by the end of the year. I was forecasting a 3 to 4% increase in materials costs. Now I think it'll be more like a 0 to 3% decrease for 2020. And then as prices start moving up again next year, I don't think they'll catch up to the level they were at, but they'll be on a slower growth path. So I think that the materials cost side will be good. In terms of labor costs, again, we had more moderation in labor cost increases than I had expected. Tomorrow we'll be getting a measure from the Bureau of Labor Statistics called the Employment Cost Index for the first quarter. I think that that's likely to be subdued, although a lot of that would have been built in before the coronavirus impact started hitting in mid to late March. But whether contractors will be able to find or keep the workers they need, bring back workers when they're ready to hire, that sort of depends on how quickly construction resumes compared to other industries. Back in the Great Recession, construction started losing workers in April of 2006. That was the high point. The hiring didn't begin again until January of 2011, almost 5 years later. Whereas the overall economy, the job losses were much more concentrated and much shallower. The construction industry lost 30% of its employees, overall economy 1.5%. And the overall economy has set records for 5 years in a row until February in the number of people employed. For construction, the industry was still below the all-time high, as was Tennessee in that slide that I showed as of February, and then we had decline in March. So we really have been playing catch up ever since we put out the help wanted signs again in 2011, which was well after other sectors began hiring. So the industry lost workers. It wasn't able to hire workers, promote workers, and this time we may be in that situation, but I'm hopeful that with things like the PPP and other programs that I hope will last more than a few weeks, that the industry should be able to retain more workers and hopefully in at least some segments start hiring again sooner than we saw in 2011. So what it means for labor costs is that for now, I think we'll see less increase in labor costs, but it will really depend on the availability and the skill level of the workers that contractors try to hire when they do bring them back.
I think that was our last question.
Okay, well, again, people are welcome to email me at any time at ken.simonson@agc.org, and I would be glad to chat with you again, either this way or hopefully one of these days in person.
Thank you, Ken. You're always such you always bring us some interesting things to think about, and we thank you for your time, and hope to see you again soon. And thanks to everybody on the call. Again, we're going to have his presentation posted on our website after the session, and we're happy to connect you with Ken. If you didn't catch that email, we'll make sure his contact information is on our website as well. Thanks, everybody. Y'all stay safe out there, and we'll catch up with y'all soon, hopefully.
Okay. Bye-bye.